Welcome to SumZero. We're here to talk about Top Stocks 2022. Before I get to that, I just wanted to kind of reflect a little bit on SumZero as a community. We've obviously been around for quite some time now, and many of you have been on SumZero for many years. I think it's evolved a lot into becoming just a great venue for the exchange of well researched and sort of deeply thought of ideas across the globe. And I'm really excited to kind of see all of you here together. Regarding Top Stock itself, it's become a tradition at SumZero. We've been doing it for a number of years now. We had over 30 judges, so the winners were carefully chosen based upon the quality of their submissions, and just the sort of level of analysis they did, in terms of their ideas. So anyhow, one thing I just want to say, this past year we've been doing a lot more in the form of kind of virtual calls and meetings to not only connect you guys and the buy side community on our web app, but also through actual conversations. And that's gone well. I think we've gotten a lot of positive feedback from just analysts around the globe who really appreciate being able to kind of talk to people in a more live format, sort of like what we're doing right now with Top Stocks, and this is something we're going to keep doing. So just wanted to mention that. This year we also had some really great sponsors. So Cadre, VinoVest, and Gemini, all sponsors of the Top Stocks contest. As the winners know, the prize package was not only sizable in terms of like just absolute dollars, but also I think fairly unique. I'm not aware of any other investment community that was able to pull together, $60,000 worth of NFTs like we were this year. So I would say we got the timing right, because I feel like crypto, well, especially the NFT market, had sort of taken off like a rocket ship and then sort of lost a little bit of air. So who knows? Maybe some of those prizes end up 10xing over the next 12 months. Keep us posted. Also, we've been doing a lot with machine learning. There's an incredible partnership that we have with a company called CrowdSent. They've looked at a lot of the content on SumZero, back tested it, and built some AI-based models that actually pick stocks out of the SumZero research repository, and with the goal of beating the S&P 500. So there's a lot of cool stuff we've been doing on the AI front. Anyhow, I want to kind of get to the pitches this year. We've got a pretty interesting mix. Everything from alternative asset managers to Porsche, which we're going to be talking about shortly, and a bunch of other names. So with that, I just want to intro our first speaker. So Will Knuff is going to be talking about Porsche. He's the co-founder of Knuff and Company. It's a family office serving the needs of multi-generational families and businesses. He has an MBA from Cornell and a BS in finance from the Cohen School of Business at the University of Texas. Also a longtime SumZero member, and looking forward to hearing him talk about one of my favorite auto manufacturers. Will, do you want to start off and just give us a little bit more on yourself?
Sure. Thanks for the intro, Divya. Good morning, everyone. I can't add very materially to what Divya just said. I'm a reformed investment banker from my early days. I've always been fascinated as an investor, investing since I was a teen. And, I'm doing what I love today with at Knuff and Company with my wife, who is my partner. And we just started the business about 3 years ago, but we've been in financial services our entire careers. So going well. We serve ultra high net worth, multi-generational families, endowments and foundations primarily, but we don't have much in the way of institutional money, but open to looking at new opportunities. Anyway, this isn't really about me, so let's jump right in to Porsche. I too am a fan of the vehicles. I own two of them, one a classic and one something more recent. But I took a look at this, and given the holding company structure of Porsche SE, I just think that it's terribly undervalued. Its largest holding, Volkswagen AG, is undervalued in and of itself, which makes very little sense given its market position, its operating performance, which is admittedly still subpar today, given all the things that they've kind of been dealing with the past 5 to 7 years. But Herbert Diess is, I think, on the right path, and they're making great strides. In fact, I think they've leapfrogged a lot of their traditional cohorts in the industry in many respects. Battery technology, embracing the EV or the new auto industry space, and trying to recognize that there are synergies and economies of scale to be leveraged, particularly given their market-leading size and global position. They do have a market-leading CapEx budget devoted to EV, and their leadership, as I've said, has sort of transformed the culture in the wake of Dieselgate and any kind of residual claims or issues with respect to the original Porsche and VW merger that took place. So its shares traded a significant discount to tangible book value, even more so recently than when I first drafted this report, and an even greater discount given that for a controlling stake you'd have to do it. There'd be a takeout offer at a fairly significant premium, in my estimation. The value of Volkswagen Porsche AG division alone seems to be worth about 80% or more, fully burdened with standalone public company costs, of the entire current market value of Volkswagen. The low end of the market value range is kind of applying a mean EBIT multiple of the established or old school peers. This excludes Tesla, Rivian, and all of the kind of new auto or EV only pure players. Kind of suggests a valuation of around 88 billion for Porsche AG as a standalone entity on the low end, or 80 billion euro. A fairer market value range might be taking a look at a close peer Ferrari in terms of its brand recognition identity, although we'd have to probably haircut Ferrari's EBIT because Ferrari generates 25% sort of EBIT margins, and Porsche is around 16%. And so if you took 60% of Ferrari's multiple, at least their trailing 2020 multiple, and applied that, you arrive at something a little over between 100 and 105 billion dollars, or 96 billion plus euro, for a standalone value of Porsche AG. And this, of course, implies the rest of Volkswagen AG, which includes Audi, Bentley, Bugatti, Ducati, Lamborghini, MAN, Scania, Seat, Skoda, and Volkswagen, has a market value of around 24 billion US, or 22 billion euro, which equates to about 0.1 times revenue, or 3.3x EBIT right now. So those metrics just seem to scream that this business is undervalued. And the market is further ascribing zero value to Porsche SE's other holdings. As a holding company, it was set up ostensibly to hold the Porsche and Parikh family shares in Volkswagen. And the nice thing about it is that because it is publicly traded, that they have access to low-cost capital. They have their own cap structure. They have zero leverage at the holding company level, and they preserve their ownership stake, their influence, and don't suffer any dilution by having to sell some of their own shares to get liquidity. So it's an attractive bond-like equity, kind of with above average yield of about 2.6% right now. So you're paid to wait something. The more important questions are sort of, why is Porsche SE undervalued. And while there appears to be no durable or good reason right now, there are reasons, I think, and the lingering investor bias is certainly related to Dieselgate and possibly the Porsche VW merger is one. The settlement costs are one time and waning though, so there's no impact on long-term value. And the new EV-only car companies are obviously temporarily warping economic realities in the auto space, right? Everyone seems to be going after the shiniest, newest objects, and Tesla and Rivian certainly fit that bill. And it's hard to handicap growth and value a significant disruptor in a traditional market. But at the end of the day, we're all still making cars. We're all still making a form of transportation. While that is evolving and expanding to include other things, the automobile or form of transportation is also now a technology hub, a mobile technology hub for families and individuals to communicate, to entertain, what have you. At the end of the day, that it's still, its primary function is to get you from A to B. And so my point there is that there are sort of inherent metrics in the auto industry: capital intensive, supply chain, extensive supply chains, substantial physical plant and equipment, and you can't get around those things. Is there leverage, or are there benefits that accrue to EV only companies? I believe so. There are fewer parts. They're easier to assemble. The margins tend to be better, particularly if you've got the software and applications component that you can add to the vehicle. So, but why should those benefits accrue only to the electronic vehicles space? I don't believe that they should. I think that those can accrue to the traditional auto manufacturers to the extent those auto manufacturers embrace EV and go all in, which I believe Volkswagen is doing. So what circumstances or events could, I think, realize value for Volkswagen AG and thus Porsche SE? Well, investors recognizing the things I just mentioned and voting their dollars accordingly. I think investors recognizing Volkswagen's transformation and market leadership in EV is another, EV development is another one to consider. Any further legal victories related to Dieselgate or outstanding claims would be additive. And those are waning too. Those are in the rearview mirror. And a spinoff IPO of Porsche AG from Volkswagen AG is obviously another potential source of unlocking hidden value, let's say. And so since fortuitously that an announcement was made a couple of weeks ago on that very topic of spinning off Porsche AG as a standalone manufacturer, Volkswagen came out and made such an announcement. And so we'll have to talk about that next. So this contemplated spinoff, because it's not a guarantee at this point, was announced on Feb 25. And what are the goals? Well, the goals that were publicly disclosed, with which I generally agree, unlock value, right? I think they recognize that Porsche AG being sort of buried or fully integrated into this larger entity, Volkswagen AG, is not being recognized for the value that it contributes. In fact, as I mentioned earlier, it's, arguably represents 80% of the value of all of Volkswagen right now. And either way you slice that pie, things look cheap. So unlocking value is hidden value is one. Raising cash for Volkswagen's CapEx. If you look at what they publicly committed to from an EV development perspective between now and 2030, it's not a small number. As I said earlier, it's a market leading number. Where's that cash going to come from? Some of it's from free cash flow, internally generated. Some of it will probably have to come from additional borrowings or equity issuances, more likely the former, additional borrowings than equity issuances. And then, wherever else they can get it. And so to the extent that they're able to unlock some of this value by spinning off a portion of Porsche AG, cash proceeds that from that IPO or partial spinoff would certainly go towards their kitty or their till for CapEx towards EV development. Preserving scale and manufacturing synergies was another argument presented, and I can appreciate that. I think that's self-evident. The ability to consolidate Porsche AG on their financials going forward, which suggests why they didn't want to do a tax-free, 80% or majority spinoff right out of the gate, to allow them to have capital structure flexibility going forward and additional access to debt capital financing. So the proposed structure of this spinoff, if we assume for a minute that, kind of suspend disbelief, if you will, for a minute, and grant me that Porsche AG as a standalone entity might be worth 100 billion US dollars, or around 91 billion euro for an IPO valuation, that this would create considerable release or of kind of hidden or unlock a lot of value. The results to Porsche SE would be a special cash dividend of around $3.2 billion. An additional 56 billion in value for Porsche SE would accrue because of their stake, their percentage stake in Volkswagen. And they would be able to, there would be about $20 billion or 18 billion euro in cash raised for VW through the IPO portion alone, assuming no further sales of their own preferred shares, post IPO in the secondary market. And so they'd raise about $33 billion or more in cash for Volkswagen all in. And that's broken down into the money that the proceeds from the IPO and the proceeds that Volkswagen would get from Porsche SE, because Porsche SE, what's contemplated is that they would have to purchase 25% plus one share of the ordinary shares of Porsche AG to be issued as a part of the spinoff. What are the outcomes? Well, preservation of operating efficiencies is one, because the suppliers, the facilities, engineering, IP, all of that still remains sort of in-house and shared under the VW umbrella, with minimal additions to admin costs. Visibility into Porsche AG as a standalone operating business, because it has been, at least partially spun off so that the market can really see through and look at those numbers on a standalone basis. Indication of margin expansion from the EV conversion, I think, is another. And accelerated EV transformation for both Porsche AG and VW. Hopefully positive investor biases, such as the primacy effect, the halo effect, and the effect heuristic, will also be positive outcomes that swing investor sentiment to thinking that this is a good opportunity to own right now. I don't think I could conclude without saying that the impact of recent events, or at least addressing them to the best of my ability, while not entirely immaterial, despite sort of fears and near-term uncertainty, these recent events are temporary and fixable, in my view. The ones I'm speaking of are the recent fire and subsequent sinking of this Felicity Ace cargo ship near the Azores that looks like a total loss of around 4,000 vehicles, all VW product. Around a quarter of them happen to have been Porsches, but that's a replacement cost insurance issue, but likely will adversely affect their revenue in the near term. And then Russia's invasion of Ukraine. Supply chain disruptions. There's been talk recently that news of the wiring harnesses that supply Porsche Cayennes, and perhaps Taycans coming from the Ukraine and causing temporary suspension of certain production lines, according to the Rob report, Car and Driver, Jalopnik. There were several news agencies that sort of jumped onto this. Loss of vehicle sales in Russia. 2% of sales of Porsches in 2021 went to Russian customers. I think we have to safely assume that that's not going to persist in the near term. And Porsche AG has no production facilities in Russia or the Ukraine. And VW has just 2 of its some 136 facilities in Russia, one in Kaluga that makes VW the Tiguans and Polos and Skoda Rapids, and one in St. Petersburg that makes Scania trucks. There's also one plant that they have in Solomanovo, Ukraine. It's the westernmost part of Ukraine near the Slovakia border that makes primarily Seat and Skodas, but also SKDs or semi-knockdown kits for Audi A4s and A6s. So while I recognize those recent events, I'm a long-term investor, and I think that the overall impact on things over the long term will be insignificant. Initially, I recommended buying Porsche SE preferred shares on the Xetra for around €84 or $95 per share or better. And given investor reactions to recent events, better is happening now. So the preferred share prices look even more attractive today. I'm going to stop there. I didn't really have much more to add or say from sort of planned remarks. I presume some, if not all of you, have glanced at the report that I crafted, but I'll open it up to, I thank you for your time, and I'll open it up to any questions that any of you may have.
Thanks. Well, this is Griffin from the SumZero team. I see a couple questions in chat. So starting with Divya's, I think it'd be great if you could touch a little bit more on sort of the multiple discount that you see in the name right now.
Sorry, I'm just while you were speaking, looking at the chat. So other than Dieselgate, the first question from Divya, other than Dieselgate, why does Porsche trade at a discount to EBIT and earnings multiples of peers? Well, I think I touched on them. I think it's really, I've asked around and thrown out the Volkswagen brand name, and even today, the first thing that comes to people's minds is sort of the Dieselgate scandal. And so investor bias can be difficult to overcome, particularly if you haven't been in the market to purchase a new vehicle in the past 3 to 5 years. And that sticks with people for better and worse. And so I think that that's one, investor misperception is one of the key drivers that is contributing to the mispricing or misunderstanding. I think the other is obviously that Porsche SE being kind of subsumed or part of the larger VW AG at the moment is certainly undervalued. It's not given its due because, as I mentioned briefly in my report, right, not every dollar of revenue from a car sold by Volkswagen is afforded generates the same margins. So most VWs, the margins are very thin, low, to mid single digits. And you'd have to go to their premium brands, moving to a mid-market brand like an Audi or to a Bentley, Lamborghini, Porsche for, higher end margins per dollar of sales revenue. And I think that that's lost in the mix for many investors as well. A third may be the general lack of faith in management. But again, that's an investor perception or bias. I think that's a carryover from previous management's problems with both Dieselgate and with the perception of less than arm's length dealings with respect to the Porsche VW merger. I hope I answered that question for you, Divya. The next one is, why do I consider better risk reward investing in Porsche SE than Volkswagen? Reasonable question. One my wife peppered me with just last night. And my response was, it's just a function of bigger bang for the buck. It's a scale play. Well, I think it's more than that, but at the most fundamental level, it's a scale play. Volkswagen is a much larger entity than Porsche SE. And so if the benefits accrue from realization of value by spinning off Porsche AG and any other tangential benefits, Volkswagen is right now about like 6x the size of Porsche SE. And so if I had to invest a marginal dollar, I'd put it into Porsche SE because I'm going to get the same kick on a much greater, much greater base, or the denominator is much smaller. So I think it's more appealing. The second thing is that the capital structure of Porsche SE is very clean. It's a public holding company. It has no leverage. So it could actually it could lever up, and it wouldn't harm the cap structure or its its on financial viability as a going concern. And you get these other bets for free. The Porsche SE team is so far been taking some of the dividend money that they get and what they retain, and instead of distribute, they've been investing in mostly private, a few other public entities that are mostly automobile / technology related. So they're staying in their sandbox, staying with what they know, and they're making these other bets sort of along the line, on a small scale version of what Google does with their other bets. And so you don't get any of those benefits by just purely investing in Volkswagen.
Awesome, I appreciate that. So, we are coming to your time, end of your time here, Will. So appreciate the commentary here. And if anyone wants to get in touch with Will, you can reach out to us, or we'll find a way to put you in touch. Next up here, we do have Adam Wilk from Greystone Capital Management on the line. Greystone is a long-only equity-focused registered investment advisor. The firm utilizes a fundamental research process focused on identifying mispriced small and micro-cap securities in a concentrated portfolio of high-conviction investments. Adam actually has a background in professional sports, working in the NBA for multiple franchises, and has been a value investor since 2011 and founded Greystone in 2020. So Adam, great to be with you, and we'll loop you in here.
Thank you very much for the introduction. Please let me know if you have any issues hearing me or anything. Just ping me or interrupt me. And yeah, thank you for having me. I'm excited to be here and talk about Goedeker. Not much more to say in terms of my background or introduction. It was, I think, captured pretty well. My firm is a concentrated long-only RIA with a focus on small and micro caps across the globe, and probably a little more of a focus on US listed companies. And today I'm going to be talking about 1847 Goedeker, which is an e-commerce appliance retailer that operates across the US. I'll probably just give sort of a high-level overview of the business and valuation case, given the time constraints here, which I will probably go over, but more detailed analysis can be found on SumZero and via the write-up and research that I submitted, and I'm happy to provide additional copies as well. Goedeker is, the current version of Goedeker is, has existed as a public company for a really short period of time, following an odd but beneficial set of transactions involving two appliance retail competitors merging into a larger, more scaled, more profitable business from the legacy version. Goedeker, the legacy Goedeker was a mom and pop e-commerce retailer that actually pivoted from brick and mortar during the recession to selling goods online. Long story short, could never really gain scale, but continued to operate up until 2020. And the former CEO, who resigned recently in 2021, was responsible for taking the legacy Goedeker public. And then that kind of brings us to today, where he sort of spearheaded the acquisition of a company called Appliances Connection, which is a Brooklyn-based appliances retailer that sells appliances online. So the current version of Goedeker is now one of only 3 pure-play e-commerce retailers of luxury home appliances, brought about again by that acquisition, where Goedeker acquired Appliances Connection in this really strange transaction in terms of how it was structured, that nearly 6x the size of the legacy Goedeker operations. And as mentioned, Appliances Connection is a Brooklyn-based retailer that was founded in the late 90s, and they sell over 50,000 SKUs, including standard and luxury appliance brands, furniture, fixtures, outdoor appliances, and commercial equipment. Appliances Connection has warehouses in Brooklyn and New Jersey, and they have a reach to 48 states in the US, now 50 actually. And I'll touch on this in a minute, but the company as a whole is building out their logistics footprint, which should have the effect of covering the rest of the US and doing things like decreasing shipping times and improving customer conversion. The dynamics of the merger, without getting too in-depth, involved massive dilution to the legacy Goedeker shareholders. Again, the share count was like 6x or so, and that didn't include a large warrant issuance. The warrants are still publicly traded, and I think that the short-term trading dynamics around the deal and the subsequent press releases involving like the pro forma structure of the business, the fact that there isn't really still actually current financial data on any of the major investment platforms, or most, I should say, and kind of a misunderstood special situation, all contribute to, I guess, the stock price getting crushed following the deal, and B, the current discount today, in addition to the fact that small and micro caps are absolutely hated at this period in time, and there's been a real, just a massive flight to what's deemed safer assets, despite the relative strength of this business. And those dynamics mentioned are what got me interested initially, by looking at the deal structure, the sort of special situation nature, and then digging in a little bit and determining that this selling appliances is actually a pretty good business, and Goedeker has a real opportunity in front of them to continue to grow. I think it's important to note, again, I kind of mentioned this earlier, but the legacy Goedeker was kind of a subscale, loss-making appliance retailer, and they had just raised capital to go public, as I mentioned, in 2020, and I don't believe they would have survived on their own if it weren't for this Appliances Connection deal and then the subsequent capital raise. So there's been a lot of talk about the dilution and what management was thinking, although they're no longer involved, and the value of the business, but it actually was a net positive in my view, and very beneficial to the now combined business. Legacy Goedeker was run rating 50 million or so in sales, was reporting a net loss, burning cash, and they had a pretty weak balance sheet. I think the CEO at the time said that they could break even at around 75 million in sales, and they just weren't really there yet. A small mom and pop shop with very few employees and no real logistics or web presence would probably struggle to sell online and to kind of penetrate that part of the industry. The acquisition gave them about 400 million in revenues, and in fiscal year 21, they did about 21 million in EBITDA, or a little more, excuse me, and they purchased the business for a total of $210 million. So actually a really good deal for legacy Goedeker at the time, and especially if they can continue to execute. Following the deal close, just looking back a few months, pro forma revenue was up 140% or so during the spring of 2021. And I think the company, this should finish fiscal year 21. They report earnings later this month with about 530 million or more in revenues. And they're on track to become a $1 billion business over the next few years. Management says by 2024, but those estimates, while I think they're achievable, should always be taken with a grain of salt. And 5 of the 6 million shares from legacy Goedeker were held by insiders. So at the very least, that could maybe signal that they were on board with the transaction, despite, I guess, some of the public commentary that I saw. The story, the investment thesis and the business is a pretty simple one to understand. As again, Goedeker is an e-commerce appliance retailer that sells standard and luxury appliances and furniture and home goods. The company was founded in the 50s, and now today they carry over 150,000 SKUs, and 95% of their sales occur online. The areas in which they've invested a lot, and their primary sales channel is through their sales and service reps, which are available throughout a large part of the week. It's not 24/7, but it's most hours of most days. And that can be a really crucial part of selling appliances online, as most people historically prefer to do it in person and to get that kind of high touch service and where they can ask questions and kind of look and feel at the products. Goedeker has also worked to build out their logistics infrastructure, which now, as I mentioned, covers the entire US. And the business model itself utilizes drop shipping, where they hold a very minimal inventory, and inventory is purchased following a sale, where about 60% of their appliances flow through the company's warehouse. This obviously stands in contrast to larger brick and mortar stores such as Lowe's or Home Depot, who use a really large portion of the store as a showroom and cater to that shopper who really prefers to purchase appliances in person. Goedeker's customer base is about 85% retail right now, just people like you and I, while the remaining is made up of some government and some developer builder customers. I think they're interested in penetrating that builder and developer market a little bit more, especially given the current state of housing in the country and the kind of housing boom that we're seeing, and the favorable remodel activity. And so that's not a meaningful part of their business yet, but CEO Albert Fuerti has spoken about making inroads into that market. Selling appliances is actually a pretty good business with relatively high returns on capital and the ability to reinvest. And if you take a look at, again, companies like Home Depot, Lowe's, Bed Bath & Beyond, some of those characteristics, they obviously make very heavy investments in these categories, and they've been able to grow them successfully over the years. And they'll talk about how they can kind of continue to dump capital in those areas and earn pretty high returns given the prices and their favorable purchasing activity. I think some of those characteristics can be improved further by selling online. And as a pure play e-commerce business, Goedeker can maintain some pretty strong competitive advantages that should allow them to continue to take share from mom and pop retailers, as well as compete successfully against the likes of some of those larger brick and mortar incumbents that I mentioned. And that's kind of a key, I may touch on this later, but that's kind of a key to the investment thesis here, is that the industry is typically grown at, like the appliance industry has typically grown at GDP plus rates. So, low to mid single digits, not very fast, but the percentage of appliances that are shifting, the percentage of appliance purchases that are shifting online is growing very rapidly at about 20-25% a year, and is forecast to grow to reach about 40% penetration by 2025 or 26, which is up from about 15% today of the percentage of appliances that are purchased online. And so if you were to look at sort of just like flat industry growth numbers or industry growth numbers on the surface, you might not be able to kind of capture what's taking place here. But it's really not about the industry itself growing. For Goedeker to succeed, it's not really about the industry itself growing at 15 to 20% rates, which it obviously has been over the last 2 years as significant demand was pulled forward due to COVID and other factors, which I actually believe there are a lot of structural tailwinds in place that could continue to, where demand could continue to remain high. But this is really about a share taking story, which is why Goedeker has been able to grow at the rates they've been growing. As of Q3 of this year, their most recent report, they grew comps 38% year over year. A portion of that was pricing and not all volume. But the point is that companies like Home Depot, Lowe's are reporting mid-single, in a good scenario, low double-digit comps for appliances. And Goedeker comes out with this massive, almost 40% year-over-year growth story. And so, in my view, this is really a function of them, again, taking share from smaller mom and pop shops, especially e-commerce operations, who don't have the scale logistical capabilities or web presence that Goedeker has, and they're incredibly efficient on their marketing spend, which I hope to have time to get into a little bit. And so again, by offering consumers more selection, convenience that online shopping affords, free delivery and installation, I think they can continue to kind of execute along this path that they have been recently. And as I mentioned, touching on the penetration rate again, it can be hard to get kind of an accurate rate depending on the source, but I've seen estimates as low as 13% for online or e-commerce appliance penetration, and around 15 or 16% on the high end. There's a Bain and Company report out there that was really helpful, that again said that penetration could reach around 40% by 2025. So Goedeker will have a significant chance to capture a portion of that spend in order to reach that 1 billion in revenues, which is about double the size of the business today. And at that rate, even at $1 billion, they would still only represent a really small chunk of the market, about 4% in my estimation. Goedeker is currently being led, as mentioned, by CEO Albert Fuerti, who was the founder, along with his brother Eli, of Appliances Connection. And again, that's the business that Goedeker purchased. As mentioned a little bit, Appliances Connection brings their more scaled operations, their logistics expertise, their really efficient marketing spend, and their distribution capabilities to the table. And Albert's focus and management's focus moving forward is scaling the combined business by, again, improving customer conversion, trying to reduce delivery times, through which they're building out a couple additional distribution centers across the country to widen that reach, and to continue to focus on a wide variety of products. Albert has actually put forth despite making a lot of money in the transaction in terms of the cash portion, he's put his faith behind the business and made pretty significant investments or purchases of shares in the open market. Since becoming CEO, he's purchased $1 million worth of shares on 2 separate occasions, which I view as pretty significant given the size of the company and I think what he thinks he can accomplish. Today, while I touched on the reasons for the discount and mentioned this a little bit previously, I'm a little puzzled by the fact that a fast-growing, cash-generative e-commerce business with real products, a decent moat around the business, and the ability to take share moving forward is pretty much left for dead right now at today's valuation. I think it's sub 5 times next year's EBITDA or something. And appliance retailing isn't, the sexiest business in the world, but the valuation, in my view, doesn't make a whole lot of sense given what they've accomplished and the growth runway moving forward. I think fears surrounding inflation, continued supply chain woes, a slowing economy, a potential recession, take your pick. A consumer products company selling goods at pretty high price points might not seem like the ideal positioning right now, but through my research, I basically uncovered that appliances are this sort of strange consumer goods category that actually hold up quite well in recessionary environments and seem to have a decent amount of price elasticity. We're actually living through this right now where most of the major retailers are reporting higher than normal, or I guess normalized positive comps. A lot of that is due to pricing, but the fact that they're having issues on the purchasing side because of materials and supply chain issues has actually not affected them at all in terms of sales, because they're able to pass all of those things right on through to the customer. And so I'm a little bit comforted by the fact that, I'm also additionally comforted by the fact that Goedeker is seeing most likely a large chunk of their mom and pop competitors with limited operations and no web presences struggling to keep up with demand during this period. During the third quarter, Goedeker reaffirmed their full year 2021 guidance, where they are calling for revenue on a pro forma basis to be between 520 and 550 million. Gross margin will be between 22.5% and 24.5%, and pro forma adjusted EBITDA margins will be between 9.5% and 11%. Using the midpoints of that revenue and adjusted EBITDA guide, they should finish the year with 535 or so million in revenues and around 55 million in adjusted EBITDA. Today's valuation is depending on the capital structure and how, if you want to include the warrants, which I do, the fully diluted valuation is somewhere in the neighborhood of $300 million or possibly less today. I haven't looked at the stock price. The way I'm looking at valuation can kind of be broken down into three scenarios between a bull case, a base case, and a bear case, which is typically how I like to look at things. Again, the details of this are provided in the research that I posted on SumZero, where I break down the numbers a little bit more, and don't have a presentation in front of me, so I apologize for that. But in all the scenarios, I make assumptions about order growth and fill rates, revenue growth, gross margins, operating margins, and EBITDA or free cash flow generation. And to just go over the base case, my estimates call for revenue growth below the company's recent execution, as well as assumptions for lower gross margins, higher than expected SG&A for the year, and EBITDA margins to decline slightly, just to be conservative. But in my view, if the company continues down their current path, I don't believe there will be a case to be made. I don't believe there will be a case for conservatism because all of the fundamentals should improve moving forward. There's some operating leverage in the business. The company's fill rate, which is well below their historical average right now, should improve. The fill rate is just what percentage of orders get filled versus canceled. And their historical fill rate, according to management, has been around 80–85%. It's currently in the 60s right now and touched an all-time low last quarter, even though they still grew 40%, still grew revenue 40%. And so as the business continues to execute, all of those things should improve. And so you have this really interesting dynamic here where if the company just does their simple block and tackling, continues to execute, supply chain starts to normalize, and the demand picture remains elevated, there's actually room for really significant or explosive top line growth here. And again, on the back of increased demand. The last part I'll note there is that the company really hasn't been pressing the gas on marketing. They're very efficient in that area, spending around 2% of order value on marketing, which is pretty incredible for an e-commerce business. And so I guess, again, to use this phrase, pushing the gas on marketing and trying to touch on different channels to get in front of the consumer, I think will go a long way in terms of allowing them to capture share. They're also undergoing a rebranding right now where they're going to change the name, which I couldn't be happier about, because 1847 Goedeker Inc. Doesn't exactly scream, we sell appliances online, and could probably use some work in that area. And so they've currently hired a PR firm or a marketing firm, and they're currently going through some options for changing the business name, and along with that should come logo. So I see SumZero's on the call. So wrapping up there, basically, it's important to note that even if the company kind of fails to meet my expectations, I would find it very difficult to see a knowledgeable buyer come along within a few years' time using conservative business assumptions, wanting to pay less than today's price. So I continue to like the setup moving forward.
That's great, Adam. Thank you. Any questions on the line for Adam? Now, put it in chat or feel free to speak up.
I should add too, while there's questions rolling in, maybe I should add too that there are publicly available warrants. That's another way to sort of get involved with this situation. The warrants have a strike price of $2.25 and expire in 2025. So you kind of get and they're actually significantly undervalued in my view as well. Disclosure, my firm owns some of those, and so that's another way to get involved with the business that provides a little bit of leverage or juice to returns to go down that path should the common stock work out as well.
I just see one question for you, Adam. Why do you think Albert sold to Goedeker?
Yeah, it's a good question. I actually get that question a lot, and I can give you sort of his high-level answer after speaking with him. And look, Albert and his brother operated this business for almost 30 years, and I think this was a way for them to get liquid. That probably explains a portion of why he took a large chunk of cash instead of the whole thing being equity moving forward. I do view his interest as aligned, but well, look, when you're a private business owner and you, have worked your entire life to build up a business, and you have somebody come along who's interested in paying you a significant sort of generational wealth type of sum, and maybe you don't have kids who are psyched about going into the appliance business, you probably take that opportunity if I had to put the pieces together. So I would say a combination of he was okay. So before he was CEO, he was the president, and then he was moved up to the CEO role following the resignation of the former CEO. And so I think his involvement in the business was also the other reason why he sold, knowing that he could potentially get involved with a more scaled and significant operation. So the combination of wanting to get liquid, a significant sum offered, and then getting involved with a new company, I think would probably explain that.
I appreciate that. I see, another one in chat there for you. So what's your basis for your belief that they're interested, or rather those on the, previous question, but when do you think the company will have DCs in Florida and California?
So talking to the former management team, they were in a little bit of a hurry to get those up and running. I think the focus has been shifted a little bit to just getting through this current environment in terms of the supply chain and meeting customer demand. The management team today has said that they're interested in taking it slow. They're not in a hurry. As of today, they can reach 50 states. The shipping times probably aren't favorable compared to maybe some of the big box guys, and so they are working on it. I would outline maybe like a 1 to 2 year period before those are fully operational. But I think those estimates are also taken with a grain of salt. But that's kind of coming from management in terms of the most recent update I have on that.
Excellent. Appreciate it, Adam. So moving along here, next up, we do have Sia Kamalie from Skycatcher Fund. Skycatcher is an investment management firm that specializes in software and internet companies with expertise across geographies and business models. Sia is a cap intro client of SumZero as well, and I know you've got a presentation prepared for us today, so I'll turn things over to you, Sia.
Hey, Griff. Thanks for the introduction. Okay, I'm sharing slides. Hopefully everyone sees it. First and foremost, I want to thank SumZero for hosting this competition. This was the first time we participated, and it was really great. And then secondly, I want to really just a shout out to my team, Murray, Ricardo, Kyle. You guys do great work, and just appreciate what you guys have done, and ready to share that with everyone here today. So first and foremost, my name is Sia Kamalie. I'm the founder and fund manager of Skycatcher. And so who are we? Well, I think it's important to understand what's our vision. And our vision is to invest in the next generation of internet and what we call the internet of digital worlds. So this can mean the metaverse, virtual worlds, digital assets, blockchains, but my personal favorite is video games. And however you define them, we believe digital worlds will overtake analog worlds in the coming decades. Now, this shift will transform the internet from one which we consume information to one where value creation becomes borderless and engagement is deeply intertwined with our social lives. Now, in terms of achieving this goal, which is quite ambitious, there are three things that as a culture we seek to represent. We are intense in terms of our process and in terms of driving our insights. A lot of our insights come from bottom-up insights around the product. Two, we view ourselves as high quality investors, but a little bit more nuanced, where we're trying to identify moments of change. We think it's in change where you have exponential results. And three, and probably most importantly, we view ourselves as athletes, especially around the idea of having unlimited stamina and really just willing to love what you do, right? This is, as all of you know, investing is not for the faint of heart. So let's dive into a little bit just about who we are in terms of the numbers. It's about 6 years of building our track record, and we're so far so good. In terms of our approach, we actually look across both public and private companies. And we take a very much a holistic approach, with the main idea being, do we own the best assets in the space, whether it's public or private? That is a constant question we ask ourselves. And in terms of the most important fact here is we are all in. Happy to say that all my net worth sits in the fund today, and I remain the largest single investor in the fund. And then in terms of our strategy, we're not for the faint of heart. We're a high conviction strategy, around 5 to 7 holdings, but our top 2 usually represent more than half the fund. And our end goal really with high conviction is to underwrite 30% IR opportunities. Okay, let's dive in today in terms of our pitch around Square Enix. So first, I want to kick off with just going into our framework so that you have context to what is the repeatable process that we have employed in terms of identifying for our franchises. Then we'll go into our bottom-up insights around Final Fantasy Online. We'll then talk about what the market misunderstands, then get into the optionality that we see. And then last but not least, we'll end on valuation and really the multiple ways we think Square Enix offers investors to win. So a key part of our framework is this idea of a forever franchise in video games. Now, most people, when they look at video games, they think of the chart on the right, this boom bust, which is pretty much true for 98% of the games out there. But our argument is that there's about 1 to 2% of the industry in terms of quantity that are these forever franchises that have lasted for 10, 15, 20 years. And what's great is, as a bottom-up investor, you can own these assets because they're being valued very similar to these games on the right-hand side. And if you buy into the thesis right here, you'll understand our excitement and why at Skycatcher, video games represent close to 85% of our portfolio today. Now, in terms of our framework, we keep it simple. The first part of our framework of investing in games is we want to identify forever franchises. Previously, we've invested in 2 Korean companies who followed our framework and yielded really great results. One of them was a company called Crafton, the other one was called Pearl Abyss. Now, part of our framework is we're waiting for moments where the market doesn't appreciate it. And this essentially just means we're trying to buy stuff at very low multiples because the implied expectations are quite low. But then the third part where things get really interesting for us is, which warrant high conviction, is, are we getting a lot of free optionality? And I think it's important to understand this point here because many people, when they look at especially sell-side research, they're always betting on pipeline. They're always betting on future game coming out. And that's actually the opposite of our approach. We're not trying to forecast pipeline, and we want to essentially get a lot of that for free. So we believe Square Enix checks all these boxes. And obviously, it's the beginning of our investment thesis. It's only been 6 months that we've invested, so it's too soon to say in terms of the return side. Now, to introduce Square Enix, big picture, this is our top position. It represents 45% of the fund today. And if you knew nothing about games and you just went to Google and you search what's the best game today, Google would actually spit out this result that you see here, the screenshot. It would show you that Final Fantasy Online, which is a title from Square Enix, was the winner this past year, beating Fortnite, Call of Duty, Genshin Impact. Again, probably titles you're more familiar with, but I share this with you because Square Enix has some really great assets, with Final Fantasy being the special part that we're really going to focus on today. In terms of the big picture, so Square Enix is a $5 billion enterprise value business. It has, in terms of balance sheet, no debt, net cash 1.3 billion, and about 3 billion in revenue, and in terms of margins, about 14%, which is on the low end. Now, the key forever franchise here, now they have actually multiple, it's a portfolio, but the one that we're really going to focus on today and the key to our thesis is Final Fantasy. So I want to give you a little first background to Square Enix and just give you a sense of how we execute our investment before we get into the thesis itself. So we've known the company since 2019 when I visited Tokyo Game Show, and it was only until 2021 that we invested. Now, it's important to understand that I highlighted earlier that we're looking for moments of change. What changed in those few years? Well, the key thing that changed in this past summer was major streamers from North America and Europe started picking up Final Fantasy Online, and we started seeing that the user base started growing from Japan within North America and Europe, and that got us really excited. Another thing happened was about every 2 years, the franchise introduces a major update, and each major update leads to more subscribers. During this period, this past December, as many of you know, markets were pretty tough out there, and so Square Enix felt it. But when we were looking at primary source data points, we saw really great things happening at the user level, and that's what caused us to further size up. And then most recently, Square Enix reported earnings a couple of weeks ago. They beat consensus estimates by 50%. Year-over-year growth was over 100% growth. And this goes to just show you, if there's one thing that you can leave with, is that when it comes to sell-side coverage, no, we don't believe anyone truly understands it. Hence, why everyone's missing consensus estimates by a very wide margin. Now, if I leave you with one slide and one slide only, this would be it. To sum up our thesis, we believe Square Enix, in terms of just immediately today, offers about 2.9x upside, and that the core idea around that is Final Fantasy being worth close to 7.6, called $8 billion. And if you take a longer term view, right, looking at multiple years, which we do, we believe it does offer a very juicy IRR with a combination of both fundamental growth and multiple expansion. Now, let's dive into the key part to our thesis, which is Final Fantasy Online. So Final Fantasy is one of the best forever franchises in the world. It's about 34 years old. It's got multiple titles. And the best part to this asset is this online game where they have paying, which we estimate about 1.5 paying monthly subscribers. Now, subscribers is incredibly important because what I'm trying to kind of shed light on here, which really goes missed in all the research out there about the company, is that subscription revenue is the rarest form of revenue in games. What you see on the pie chart on the right, it represents, by our estimates, only 1% of game revenue is actually subscription, right? And we believe in terms of Square Enix's revenue, which is about 3 billion, Final Fantasy Online is about 600 million of that total bucket. And so our core thesis is around this idea of attaching a higher multiple to this high quality revenue stream that really doesn't seem to be appreciated. Now, why is subscription revenue important? Well, very similar to a SaaS business, right? Why do you pay for that? It's because there's a lot of operating leverage there. And then when you compare it to single game revenue, right? Traditional games, your LTV, your lifetime value of a customer is $60. But in the case of Final Fantasy, in our conversations with the company and also doing our own research, the average player has been a subscriber for about 5 years. And when we say subscriber, right, they're paying $15 a month each month. So the LTV is clearly much higher than a traditional game, and you should look at it from a different lens. Now, it's not just about spending more or great monetization. I think another thing that we like to look at is what's the kind of engagement. One of the factors we look at is how many hours are players playing a week? And for us, a key metric is 20 hours per week. If most of your player base is playing more than 20 hours per week, you have something really special. In fact, you have something borderline a second life. Now, when you compare this to Roblox or Fortnite, which probably many of you know, the total player base doesn't come close to what Final Fantasy does. Now, obviously, they're very different scales, and Final Fantasy is a very hardcore game, but I highlight this to show that the quality of this engagement is very high. Now, let's get into the game itself, right? And a core part to our thesis is that Final Fantasy, it has paying monthly subscribers, but with each content update, as you see here, it continues to keep growing, right? And what's interesting is this most recent update, it's kind of led to this more inflection growth point where you started to see that it's starting to take off, right? And I think for us, we believe this, we saw data points going back 6 months ago, hence the beginning of our investment, but the more and more we continue to track it, we continue to get more conviction around the subscriber base growing quite rapidly within Western markets. And then just kind of food for thought, right? This is not core to our thesis, but when we look at assets, we do like to find assets that have latent revenue sources. And for Final Fantasy Online, it's a 10-year game. It's been $15 a month for the entire 10 years. And you could probably imagine that content costs have actually increased quite a bit each year. And if Square Enix were to hypothetically ever raise prices, then we have a lot of operating leverage, or earnings per share could grow quite massively from here. And to wrap up here on Final Fantasy, so we believe at a total franchise level, it's about $1 billion in revenue. And what we've done is we've looked at each segment of Final Fantasy in terms of the types of games. And we said this online revenue, which is normalized EBIT margin. And this is actually reported at a group level. So we know that margins are actually there. And this is not something that we have to guess too much on. We're saying we're going to treat this earnings, we're going to attach a 20 times multiple here, right? And then you get a blended multiple of called close to 19 times. And if you buy into this logic, you'll quickly realize that Square Enix is trading far lower than the value of the single IP, which is Final Fantasy. Now, let's get into what the market misunderstands and what we think is really kind of shadowing overall this, and which you'll read a lot about if you see sell-side research. So Square Enix report has 4 business segments. The most important and the focus of our conversation is the digital entertainment segment, which represents 80%. That's the blue that you see here. Now, within this segment, they have 3 types of games. And one of them is called HD Games, which is a segment for PC and console. They have another segment called MMO, this is the segment that Final Fantasy Online sits. And you can see that its reported earning margins are actually 50%. And you have another segment, which is called Games for Smart Devices and PC Browser. This is basically mobile games. And then the group level is the blue. So when you look at the blue, that's the group level for digital entertainment. And so you quickly realize this red line here, right? This HD Game segment, it's really dragging down the rest of the group. And we believe that when we look at what's happening here, they're actually quite temporary factors, right? And it's not structural factors. So what do we mean by that? Well, as I said before, we get into the product and we really try to dive deep to understand what's going on at the business level. And on average, Square Enix report launches about 15 to 20 games a year. And so we've come up with this idea of a batting average. And if you looked at kind of this blue line and you look at the right-hand side of the chart, you'll see the batting average of Square Enix prior to 2019 was close to 50%, meaning for every game they launch, half of them actually end up successful. In the last 2-3 years, this has actually come down dramatically to a batting average of 20%, which has resulted that HD Games has been this major loss factor for the rest of the overall group. And again, if you think about games and how they work, right, these are temporary factors, right? It doesn't take much for this to go back. You just need to kind of have winners or launch less games, right? There's a lot of ways you can look at this. Now, another thing to kind of think through as you look at kind of what's happening with Square Enix, right? Prior to these HD Games segment underperforming, Final Fantasy as percent of EBIT was actually quite small. And then as a result, it's come a really big part of it. And our one way to look at it is that if this segment returns to profitability, then Final Fantasy as a percent of EBIT will come down dramatically. Now, you shouldn't look at our forecast and take it for what it's worth. It's more about understanding directionally where we'll be, because pipelining games and thinking about each time that Square Enix launches a game, right? You really can't predict this very well. So it could happen really quickly where all of a sudden you have a big hit and Final Fantasy goes back to being 20% of EBIT. In that scenario, then this ends up being a really great time to get vested. Now switching into the free optionality and kind of what do we get? And we'll kind of go through this part quickly because it's not core to our thesis, but it's important to understand that there is much more to this company than this one asset, Final Fantasy. So when we take Final Fantasy out, there's about 2.2 billion in revenue. And this is across a portfolio of 5 IPs and 3 business segments. And we conservatively believe that this is worth $5.7 billion. And then second point is Square Enix has a pretty rich pipeline. And we believe that this pipeline on the blue sky scenario could generate another 5 billion in revenue. And we're treating this optionality as an additional, we're valuing this at an additional $1 billion. So what are some of those IPs? Well, you probably know Tomb Raider. Dragon Quest is a very successful IP and still growing. Space Invaders is very old school. And they have a couple of IPs with collaborations with Disney, with Kingdom Hearts. A lot of people, when I get questions about Square Enix, they think of them as a AAA kind of console, old school player. But it's important to understand that in the last few years, they've become one of the top mobile game publishers in Japan. And this chart shows kind of Square Enix against its peers within Japan. And in terms of pipeline, so if you look at the left-hand side, you'll see that the gray is what we actually forecast. So we don't put a lot of our forecast weight around pipeline, but the blue is the pipeline potential. And this is us just saying, you know, we don't want to make a mistake of missing on the upside, not understanding what's okay, hello. Can everyone hear me? Okay, yeah. One of the biggest games that is coming out is a title called Forspoken, which they've spent 5 years building, and we believe could be a major hit as a PS5 exclusive. And then last but not least, as I mentioned, Square Enix is more than just a game company. It's actually an IP builder. One of its great assets it has a great anime publishing business. And that business has actually expanded margins from 24% to 44% on the back of digital sales. There's a lot more to talk about Square Enix on the other assets, but again, that's not core to our thesis. It's just important to highlight that there's great assets over here. So wrapping up, our last section is going into the multiple ways that you can win with Square Enix. So why now? I think the most important thing to understand is our thesis is driven around earnings growth, and not just the multiples being cheap. And when we compare Square Enix compared to its peers of AAA video game companies, it really does stand out as a company that isn't being truly priced for the growth that we see kind of going forward. But this isn't the best start. This slide is probably my favorite slide in terms of looking at valuations, comparing it to the rest of the game companies. So what you see here is looking at EBITDA margins last 12 months, and then on the other axis, you see revenue multiples. And it's a very clear correlation where as game companies report higher EBITDA margins, naturally the market's attaching higher revenue multiples. Now, Square Enix at 14% EBITDA margins last 12 months, that's not really where it's at, right? As a software business, we know it can be much higher, and our own estimates is saying, look, you can do better than 20%, right? But it's important to understand that as an industry, right, these are software businesses, and Square Enix today is not being valued as such. And when we take kind of that 5-year view, right, getting to that bigger, juicier IRR, in the long term, right, we see that Final Fantasy will still represent more than half of its value, but the rest of Square Enix is actually not a bad business, and it's something that will get us to that bigger upside. So where can we be wrong? So Square Enix it's a really great company. I mean, I think one thing that is important to understand that in some ways it is very Japanese, with the part that is the most challenging for our thesis is actually the market maybe not seeing the true economics, where they're being overshadowed by the HD game segment. And that's mainly because, look, Square Enix doesn't make the reporting structure easy. I think a lot of the slides that you've seen here today is our own estimates, and it's not Square Enix going around and really telling the story about how great Final Fantasy is, talking about subscription revenue. They in fact almost really kind of avoid it, we feel like. And our hope is that this also has what's created this opportunity today to buy an asset at where it's trading at today. Other long-term considerations. So we do take multi-year views, and with that, it basically implies that capital allocation is incredibly important. And for us, one of the big questions that we're asking game companies is, what is your strategy on blockchain games? And Square Enix is actually at the forefront of this in terms of comparing to other public listed companies. This past January, the president wrote a note about blockchain games. And then back in 2019, Square Enix led the Series A round in a blockchain game called Sandbox, which is one of the biggest games today, and its token value is about $13 billion. And we believe they own single digit ownership here. But again, we're not really attaching value to this, but I'm only highlighting this, that this is a company that is very forward thinking and is kind of making the right long-term capital allocation decisions. Another thing that we've done to kind of further our insights around here is we've looked at all the public game companies, the video game companies, and we've kind of tried to understand what is their blockchain game strategy. Square Enix is actually one of 4 companies that has live games today. There's another 7 that are looking to implement in the next 12 months, another 14 that are kind of learning, and then the rest of the industry, no strategy disclosed. And we, again, believe that long-term investors, this is one of the most important capital decisions that you'll make in the next decade for video games. Wrapping up here, so the most important variables to our thesis, just to reiterate, we believe Final Fantasy is worth close to $8 billion. The key assumption here is the online business, you're attaching a 20 times EBIT multiple here because of subscription. 2, the HD game segment can return to profitability, right? And it can achieve margins of better than 20%. You have to really just believe that the underperformance here is temporary and it's just a function of the batting average improving. And then last but not least, again, it's a bit of a circle reference because you have to believe number 1. But if you believe number 1, you're getting a great portfolio of IPs and assets for free. And to look at this from a stock perspective, from another way, well, at Skycatcher, one of the key things that we always look for high conviction is we want a growth story, we want a margin story, and then the triple whammy is getting a story where multiples can re-rate. We believe Square Enix actually has all three that we like to see. Hence, it warrants our highest conviction position weight that we would go to. Now, I want to kind of zoom out and just as an allocator, think about where does this fit in your asset allocation and share with you some of these bigger picture industry trends and where Square Enix fits in it at a bigger view. So big picture view, it's important to understand that video games and social network valuations are actually converging. What you see here is 2010, 2015, 2020 revenue multiples. Now, we believe that video games could even surpass social networks because remember, video games are social networks that are active engagements. You are really into it as opposed to most social networks are very passive experiences. And if you believe data and time are very valuable, which we do, you want to own data and time that is in active mode, not passive mode. Secondly, the industry is consolidating, but it's really accelerating. This past January, many of you know that Microsoft made its biggest acquisition ever, acquiring Activision. Take-Two also made an incredible acquisition with Zynga. And these are all at multiples that are much higher than where Square Enix is trading at today. So does this continue? Well, we believe so. But keep in mind, Facebook, Netflix, Disney, Apple, right? These are players that have lots of cash. And I think you have to understand that games is not a business you throw money at, but it would make sense for especially Disney to potentially buy someone like Square Enix who they've done tons of work with in terms of cross collaboration. And then I'll leave you with kind of some big picture, blue sky thoughts, because this is something that really keeps us up at night and is actually driving a lot of our process across both public, but also on the venture side, where we've been quite active in the last few months. So games is $175 billion industry today, but we believe maybe the biggest expansion in TAM could happen, and this could be $1 trillion in TAM this past decade. What we did was we kind of took a page from Bill Gurley's Uber analysis, where many people missed the Uber TAM because they thought it was just the cab market, right? But what you miss and what we're arguing for blockchain games is that there's potentially going to be a labor market in emerging markets which move to in-game service jobs, right? And what we did was we said, as a percent of labor market, let's say 2 or 3% of emerging market labor market moves to a job in a video game, right? And then on the other end, well, if they have jobs in the video games, they're selling these assets, digital assets, to developed market users. Well, what would that do to the TAM, right? It's going to be expand the TAM quite massively. So that's the kind of analysis we did to kind of really try to think through as an exercise what would happen here. And then another way to look at this is, if you ask me in 10 years from now, what would be bigger things that we're excited about? It would be the first video game that has 1 billion people, right? And again, today, video games, or you want to look at, call them differently, virtual worlds, they're games that already have 400, 500 million people, right? Think about Free Fire, think about PUBG, even Fortnite at its peak. So this path to 1 billion, though, we believe that maybe it's blockchain games that get us there, because you take developed market gamers who, they spend 8 times more than normal gamers, they're money rich, and then you match make them with emerging market gamers, which there's twice as many of them than developed market gamers. And all of a sudden you could really see games where there's going to be players who play and there's going to be players to earn. And the game companies all of a sudden become platforms where they're just taking a take rate and you're letting value cross borders, again, being borderless. And last slide, wrapping up here, I think the most important top-down questions to ask yourself are video games the future social networks? Will this industry continue to consolidate? And then is there a 10% chance that blockchain games actually unlock this market that we're talking about? I think you know where we've positioned ourselves, but if you answer yes to one or even all of these, then I think it's important to ask yourself, how are you allocated here, and what is the right exposure to capture these structural trends? This wraps up the presentation. Thank you so much for your time, everyone.
Hey, thanks, Sia. That was fantastic. I really appreciate it. Kind of piggybacking off of one of the questions in chat, talking about kind of their capital allocation strategy. You mentioned that a little bit. So it'd be great to hear how they're working to create shareholder value there. And I think it'd be particularly interesting, given the headline news, for you to touch on sort of the M&A side and sort of the consolidation that we're seeing there a little bit more.
Yeah, so Square Enix and this is coming on our channel texts and kind of with Tigis and such. It's a company that's not managed by business people. It's managed by the creative people, and hence have these lower margins. But we actually think that's probably the right long-term move, and there probably should be a little bit more discipline around spending. But it's not a company that they do spend, and the best creative people in terms of Japan, they want to work at Square Enix, right? So, and ultimately, if you think about what is a game company's number one asset, it's actually the people. It's being able to attract creative people over. And if you look at kind of this challenges that Activision Blizzard's facing, they went the other way, right? The business people took over, they over monetized, and all the creative people are leaving. So I think that's just an important data point to understand. And then in terms of long-term thinking, the founder owns 25%. That's been a stake for a very long time, right? This is an old company. Yep. So we don't think that, he's making decisions that are short-term. In fact, they're always decisions that are long-term thinking. And to give you a little bit of sense, compared to other Japanese companies, they are very much happy to embrace new trends. So even when like AR, VR was a thing, they were really early there. They made mistakes, but I do appreciate and almost per management teams that are willing to kind of take a chance, because the opportunity cost of missing something is something that I think is more important to understand, that in the world of games, it's very much levered to technology changes, right? If you think about where games were 15 years ago, you didn't really have multiplayer because the internet wasn't there. You didn't have hardware that was there. Now that you're multiplayer, you have that. So yeah, I hope I answered that question, Griff.
Yeah, thank you. And kind of piggybacking off of that, I see a question in chat here. How do you sort of expect their batting average, to quote you, to improve on the HD game side?
Yeah, so I think you could look at this and say, look, HD game segment is basically their R&D kiln. So if Square Enix plays it safe and just said we're going to launch games in Japan all day long, then the HD game segment will be really profitable quickly. But it's important to understand, last 4 or 5 years, the company has gone from Japan being close to 80-90% of total revenue to now Japan being only 60% of revenue. And we think that goes down further because they're making a concentrated effort to expand into Western markets. And with that, it means you're going to launch games in the West and you're going to fail, right? And so I think that's the important thing to understand, is like long-term, if they can diversify their revenue streams beyond Japan, which they are doing that, then that is actually the right decision to do. And there's going to be growing pains that come with that. Just a quick example to think about, this title, Forspoken, that we mentioned on the presentation, you can look it up. It's got like 5 million trailer views on YouTube, and it's actually quite anticipated. But this is a game that was in development for 5-6 years. They've spent God knows how much, but they've changed the character right now to something that's more Western friendly and in line with the times. If you look at kind of the look and feel of the character, it was not, Forspoken a year and a half ago was a very different look and feel. So, we think they're going to get there, right? It takes time.
Yeah, and I just see one last question here coming by way of Eric Gregg, which is kind of a nice segue into our next segment here. But do you foresee the valuation discount really just being a factor of the Japanese market, or how, on a relative basis, does this look compared to the other Japanese video game makers?
Yeah, I think Gregg, Eric, that's a great question. So our thesis is that people have to understand that games is one of the truly global TAMs. I mean, the moment you're on an app store or on a console, you get revenues from all over the world. And so we don't think this Japan discount is the right way to look at games. Hence, if we think about our investments in our Korean companies, Krafton and Pearl Abyss, they're both Korean companies that actually, Korea as a part of the revenue is actually the smallest part, and they get global revenues. So our view is that as long as Square Enix continues to grow its non-Japan business, then this idea of thinking them as a Japan business is the wrong way to look at it, and they're going that direction. So that's been our view around games, is we want to own game companies that are actually building global IP. And it is hard, but remember, Square Enix does have some global franchises like Tomb Raider and Kingdom Hearts, which is a collaboration with Disney. So yeah, I hope that answered our question, Eric, around the valuation. We try to really think holistically and not limit them just to that one country, because that's not where they're trying to be at. So it's where they want to be in a few years is really a global, and they're almost there, right? They're kind of, let's say, halfway there.
Awesome, Sia. Any other questions for Sia before we move on? Okay, great. Moving along here. Next up, we do have Gregg with us. Eric is the founder and principal of Four Tree Island Advisory. It's a registered investment advisor offering 3 distinct strategies: capital appreciation, total return, and out-of-the-money put selling strategy. It's a fundamental driven value-based money manager that is market cap and sector agnostic. So with that, Eric, I do see you've got a presentation loaded up, so I'll turn things over to you. Welcome.
Great. That was going to be my first question, to see that if you saw it. So thank you for that. And thank you for the nice introduction, and to Divya, Brayton, and really the whole SumZero team for facilitating this type of communication and the platform. So just a little bit of background here. Four Tree Island Advisory, we've been at this for about 10 years for outside investors. My background was, I'm a reformed investment banker. I worked for 15 years started out at Goldman, at Deutsche, Morgan Grenfeld after that, then at DLJ, and then at Credit Suisse. Really built up a focus on, what are great companies and great management teams and capital allocation over time, and really, what are great things to own for years, and what are things you don't want to touch for a few seconds. We take a very concentrated approach here at Four Tree Island Advisory. We go very deep in the things that we get involved with. And currently we're focused a lot on a few specific sectors, including industrials, financials, tech, specifically semis within tech, and healthcare. So with that, I'm going to spend the whole time today really focusing on this Mueller Industries opportunity. So Mueller constitutes, in my view, a number of different things. One, it's a highly underappreciated water infrastructure play. And water infrastructure is so important to so many different types of investors. It's a sustainable margin expansion story. It's a play on copper. It's a company that's likely to be in the midst of a major shareholder payout program that we think might be happening now and hasn't been announced. It's a starkly mispriced undervaluation story. It's a hidden gem, little public market exposure story where higher market recognition seems almost inevitable. And it's a situation where the valuation seems highly likely to keep on accreting, or a takeout by either a strategic or PE is likely to happen. So orienting you all, and I'm going to assume that, I'm not going to assume that everyone's read all this that I've written on Mueller. Mueller has 3 specific segments, and they break down between the piping system segment, which makes pipes, fittings, line sets, pipe nipples, and resells a lot of other plumbing products, including faucets and valves. It also includes an industrial metals segment, which manufactures brass rod, copper, bronze, aluminum for various industrial uses, including in the HVAC, industrial plumbing, refrigeration, automotive, gas appliance, and construction industries. And then its third segment is its climate segment, where it manufactures valves, protection devices, and brass fittings for various OEMs in the commercial HVAC and refrigeration markets. What you'll see in the table on this page is how explosively Mueller's business has grown in 2021 and how much its margins have improved versus where it was in 2019, particularly in the piping systems and the climate segments. Margin in its piping system segment, which is over 2/3 of its revenues, have more than doubled, and margins in the climate business are up 50% over the last 3 years. So what's driving all that? And why do I think the outlook is going to continue to be good for a number of years here? There are 5 major drivers First one is the growth in residential construction. They benefit from both residential and commercial construction when building, and whether it's rehabs or new construction. But this is a huge driver for their business. And as you can see on the chart reflected on this page, it's up 13.2% in terms of domestic, residential construction over the last over January of 2021. Additionally, Mueller is a significant, driver number 2, is copper prices. And a lot of people might not, when they first think, they would think this would be actually a bad thing for the company, but not the way they run their business. While the company won't clearly concede to it, Mueller effectively charges at a margin to copper prices. Copper is 70 to 80% of the COGS in its piping business, and a meaningful component of its COGS in the other segments as well. Mueller is so sensitive to copper prices and has learned this over time that it has built the capability to change its pricing for its products multiple times a day, and Mueller will do so when copper prices make sharp moves higher. So with copper prices up more than 50% since pre-COVID and demand very strong, they're in a good environment to drive higher pricing and capture better margins. With those better, fundamentally the OpEx doesn't go up nearly as much as what copper's gone up. And so when they're putting through a margin on top of copper, lots of that drops to the bottom line. Part 2 of this whole copper story is not only has copper gone up 50%, if you look at some of the most largest firms around the street, they're very bullish on where copper is going to go through the middle and even the end of the decade. Goldman, BofA, Commerce Bank, Scotiabank, and ANZ are all very positive on what's going to be happening next year. BofA and Goldman look out to the middle of the decade or even longer and put out a thesis where they believe between electrification of huge parts of our marketplaces, as well as various EV or ESG initiatives and green energy initiatives, that copper is going to be in significantly higher demand than it is now by the middle and the end of the decade. And on top of that, the copper manufacturing industry has a number of headwinds, including back in 2011, when they last went through a major expansion of capacity, it burned the industry. And so the industry has been very careful not to add capacity in terms of copper production. And then there's the whole ESG element, which has been limiting a number of companies from being as aggressive in CapEx as they would be historically. And you have other things going on, like in Chile, where there is talk about potentially nationalizing the largest copper producer in the world. There are a lot of things out there that are constraining supply just as demand keeps on ramping higher. Driver number 3, and this is not something that I've discussed in any of my writings on the company, and I'm just sharing in this presentation today, is there have been meaningful consolidation in this industry, which has benefited the competitive environment very significantly. So 10 to 15 years ago, there were about 7 or 8 competitors of any size in copper tubing. Including Mueller, there are now only 3, and Mueller is the largest of those 3. The other 2 are SumZero, which is a subsidiary of Marmon, which in turn is a subsidiary of Berkshire Hathaway, and Ayuso, which is a Mexican conglomerate. In brass rod, 10, 15 years ago, there were about 6 manufacturers of any size and scale in the US. Now it's down to 2, Mueller and the Weiland Group, which is a private German conglomerate. This has been very beneficial the way the market's been working in terms of their pricing and what they've been able to do in the domestic markets. Driver 4 for why the margins have improved so much is this company has been laser focused on expense management. One of the best quotes I heard the CFO say multiple times in my conversations with them is, "We measure things in half pennies here at Mueller." And in the vein of never letting a crisis go to waste, at the onset of COVID, with all the uncertainty out there, Mueller took a hard look at its costs and restructured what it thought prudent. So they cut costs and the business came back much better than ever. And that led to margins exploding higher, as you can see here, as you transition from 20 to 21. So second method that Mueller's employed to improve margins is consistently acquired and disposed of assets as it keeps on working to improve its portfolio of businesses. The acquisitions that Mueller engages in are typically not that large. They're focused on enhancing Mueller's growth profile or margin profile or both. Notably, Mueller isn't typically wed to the acquisitions it makes. If it takes on an asset and the asset doesn't do what they think they can do with it, they jettison the asset. And this happened with Mold, which you'll see in 2021, that was purchased in 2018, as well as STI, which was bought in early in 2020, and they sold it. The third means by which they've been driving margins and getting that OpEx down as a percentage of sales is, again, through the pricing based off of copper. So the fifth driver, what's been such a of their explosion in profitability and margins, has been container shipping rates remaining elevated in the seaborne container shipping market. So while domestic manufacturers have dominated the market for what Mueller makes, there can at times be foreign competition, particularly from South Korea, that brings copper tubing or brass rods into the market. But in the current environment, that ocean-borne shipping rates having increased so markedly versus what they were pre-COVID, that makes the threat of any real foreign competition that much less likely. I spent a lot of time focused on what's going on in the container freight markets as it impacts other investments that we're involved in. I don't see things changing for the better in any material way until 2023 at the earliest. So, excuse me. The table on this slide highlights the operating EPS X items for the last 4 quarters in the last 4 years, and also focuses on the growth of that operating EPS. While EPS growth was particularly explosive in each quarter in 2021, at over 100% greater than the operating EPS in the same quarter from the prior year, it needs to be emphasized that the company's consistent focus on cost reductions and portfolio management of its businesses led to consistent double-digit operating EPS growth in each of the 3 years leading up to the explosive growth in 2021. I'll also look a little bit forward and say that I'll eat my hat if the company doesn't have approximately 100% operating EPS growth in Q1 2022. The company doesn't give specific guidance. The trends are all very positive. From a historical perspective, it's worth noting that Q2 and Q3 are typically the seasonally strongest quarters. Q4 is typically the weakest quarter of the year. So we're coming off the weakest quarter, and it was the top 2 quarters they've ever put up as a company. So what this explosion in profitability has led to in all this free cash flow is since Q1 of 2020, Mueller has reduced its debt from $475 million down to less than $2 million, and has reduced its net debt by $400 million to a net cash position now of almost $100 million at $86 million. But it also means as Mueller's interest expense has gone away, Mueller was paying $5.4 million per quarter in interest expense, or about 7 cents a share after tax as of Q1 2020. That's gone. So roughly 22 million per year of expense, or 28 cents in EPS has gone away. Just as importantly, after 4 years of keeping its dividend unchanged, Mueller has increased its dividend twice in the last 13 months for a cumulative 150% increase. Mueller would not be doing this if its outlook wasn't so strong. I also submit that Mueller is leaving significant room on the table for more shareholder payouts. I estimate its current payout yield to be approximately 10% of earnings. The balance sheet is now significantly under-leveraged. Worth noting that the leverage paydown really accelerated in the second half of 2021. So thinking about with the very pristine balance sheet and all the free cash flow generation, what's going to be happening next? And this is a part of the really special situation here. Mueller has a history of major special shareholder payouts. They seem to come over the last decade every 5 years. So back in 2017 and 2004, Mueller paid a very significant special dividend. In 2012, Mueller bought back the 27% stake in its business that was owned by Goedeker. It seems the company is on this track to do something every 5 years, and this is a 5-year anniversary of the last major special payout that they did. With Mueller's outlook so strong, free cash flow generation so high, valuation so attractive, and no more debt to pay down, I think it's highly likely that Mueller will or has already started turning to stock repurchase. Mueller will also continue to its consistent efforts to improve the business through tuck-in acquisitions. In terms of stock repurchase, Mueller has an outstanding 13.4 million share which represents about 24% of shares outstanding repurchase authorization. I also think it's possible, if not likely, that the company declares a special dividend this year as well. So I'm not going to go through everything on the slide by a long stretch, but with all the things that Mueller has going for its business, the company being a clear water infrastructure play, tremendous results it's put up, and it being such a compelling potential takeout candidate, you may think its stock would be rewarded with a high valuation multiple, and you'd be dead wrong. When you compare Mueller on an enterprise value to EBITDA or EBIT multiple basis, Mueller trades at a nearly 70% discount to its best public peers. When you compare Mueller on a PE basis, the discount is even greater. The medium tier trades at 22 times 2022 consensus. Mueller is trading around 6 times what we think a conservative estimate is for 2022 earnings. Mueller's PEG is about 0.3x. The medium tier's PEG is over 2. Mueller is compellingly inexpensive. I ran an exercise here on this slide 13, and I just kept Q4 earnings constant and assumed that they put 100 million per quarter into stock purchase and looked at what would happen to EPS over 2022 and 2023. And I'll put out there that I think it's going to in the bank that Q1 and Q2 are going to be better than Q4 and probably Q3 as well. You can see that we'll get 21% EPS growth in 2022 and 11% EPS growth in 2023 if all they do with 100 million of free cash flow every quarter is buy back their stock. And this assumes an accreting stock repurchase price that starts at 56 this quarter and goes up to 91 by Q4 of 2023. So why is such a compelling, investment opportunity exist? Mueller has had historical bias to letting its operating performance speak for itself. They don't do earnings calls. They don't do investor conferences. There's no management outreach to any of the water infrastructure or ESG focused investors that are heavily invested in its best comparables, firms like Franklin Resources, Invesco, or specifically Impacts. The CFO is also head of business development. He's treasurer. He's responsible for investor relations. It's clear he's a very nice guy. You can get through if you give him a call and leave him a message. He'll get back to you. It's clear that IR hasn't been a top priority for the company. Only one sell-side firm covers Mueller, a firm that I had heard of before doing work on the company. And then they don't obviously have that high profile on the street. It's likely that those that may have looked at Mueller years ago that thought Mueller was a low quality asset due to a low margin profile, a lower margin profile than their other public comparables, may have not realized how much the situation has changed at Mueller over the last 3 years. It's also likely that some are skeptical that the current level of performance can persist, and I think that's just not the case based on all the things I highlighted earlier in this presentation. It's clear that even though the valuation is unwarrantedly cheap, that the company is starting to outperform and people are realizing this is something to be paying attention to. Mueller's outperformed its median peer by 12% year to date and by over 30%, almost 40% over the past year. So what's my warranted upside for Mueller shares? Take the peer group trading at 22 times IBIS consensus EPS. I think Mueller deserves that, but let's just take a discount to it. So I'll take a 20% haircut. We'll say that's around 17.5 times 2022. I model that Mueller will deliver $10 at least in EPS in 2022. That suggests a current warranted price of $175 or 200% upside. And I assume that that's what it's worth today. If we roll it forward to the end of the year and start looking at 2023 EPS, which I have at 11.25, that suggests a warranted price, a target price of around $197. Should my suspicions be confirmed, the company is in there aggressively buying back shares here. I think that should be a catalyst. Unless they make a special announcement, they probably won't announce that until we see it or we would see it in the next earnings release. I also think something to be on the lookout for here is a special dividend or maybe the announcement for a tender neither of those things would surprise me if they came through and did them. With that, I'll open it up to questions.
Eric, fantastic work, man. Thank you for the presentation. Appreciate it. Just going off the questions in chat here, with the two big segments consolidated, do you see the business adding another leg, or sort of an acquisition outside of its current kind of core offerings?
I don't. There's no doubt that their bias is towards acquisitions, and they would like to keep on growing the business through acquisition if they can find it, or something reasonably priced. I think there's a dilemma there in them looking out to do stuff, because unless it's really small, I doubt that they're gonna be able to buy anything as cheaply as they can buy back their own stock. And they also have some very smart people on their board. One of a former board chair who remains on the board, he's been on the board for over 10 years. He used to be the chief operating officer for Soros Fund Management. He bought a lot of stock in the open market after 2 quarters ago, after their September quarter results. And I think that it's just this board is going to do the right thing for long-term shareholder value creation. I think at this point, there's going to be a lot more stock purchase that's likely to happen.
Awesome, Eric. Thank you for that. And off the second question here, are you concerned at all with the cycle turning at all? Given back in 2009 when revenues were down 40% and EPS was down 60%.
I mean, that's clearly, I guess the question is, what would drive that? I think they've made some structural improvements in their operating margins. If you think copper is going to drop significantly, if you think construction is going to drop significantly, I think that the question is here, if you talk anecdotally to builders out there and see what's going on in the market, builders are just running flat out and they can't keep up with the demand out there. Do component elements of building become so expensive that ends up, what's the solution for high, oil prices, high oil prices, what's the, that kind of thing. So do things get, too expensive and that starts slowing down demand for construction? It's certainly possible. I have a general belief here that, outside of some of these existential things that we're dealing with right now in Eastern Europe, generally we're coming out of a period where we were shut down for a long time in this economy, where people were very worried, and they were holding back spending. And we've seen a fundamental change in the way people are looking about how they approach work-life balance, having more flexibility working from home, and that's leading to a lot of different decisions in housing. And how people want to renovate and improve and live their lives. And I think there's been a capacity issue in meeting all demand. I think it's kind of like what's going to be happening in the auto industry. We have like years of new auto sales need to happen to catch up with all the pent-up demand, because people just can't get what they want right now. So I think they have a very strong tailwind for them for a while here.
Okay. And in terms of sort of insider transactions here, I think someone in chat's noting that the CEO has sold some of his stock. Do you have any comments there?
I don't have any comments there. I'd have to go back, and I admittedly I missed that one. So I saw one of the board members make an open market purchase. I don't know what percentage of the stock that was.
Excellent. Okay, cool. All right, Eric. Thank you for the presentation, man. Appreciate your time as always. And if you'd like to get in touch with Eric, of course, you can reach out to us. He's a Cap Intro client of ours. So we can put you in the right direction there. We're moving along here, and our final presentation of the day will be from Samir Parikh on Blackstone. Samir is the founder of Juna Capital Management, which is an alternative investment firm. So Samir, welcome, and I'll turn things over to you.
Great. Thanks for having me, guys. And congratulations to Divya and the entire SumZero team for putting this together, and all the success that you guys have received. Can you guys hear me? Hello?
Yeah, loud and clear.
Yeah.
Okay. So yeah, sorry about that. So as you guys alluded to, Juna Capital is a private investment vehicle, do a range of privates and publics. The thesis is relatively simple, especially on the public side. I look for, and we look for, simple companies that are effectively hidden utilities in growth industries, and look for secular compounders. I'm going to take a little bit of a different approach here. I'm just going to give a really quick pitch on Blackstone. And given the talented community that I'm speaking to right now, I'd love to make this a more engaging conversation and talk to and hear questions and comments about what other people are thinking about the stock, and certainly the bear case, as I'm sure there is one out there. So just for full disclosure, I have been long Blackstone for well over a decade, fairly close to its IPO back in 2008, 2009. The stock did double in 2021, which forced me to kind of reevaluate the investment, and the performance metrics coming out of the quarter massively exceeded both the street numbers and frankly the numbers that the management team put out in 2018 during their investor day. So a handful of years ago, 5 years ago, I'd written about Blackstone as being the next Amazon of finance. I think I'm going to expand that analogy today. When I think about the business model today, it actually has some of the best characteristics of some of the most valuable tech stocks out there. Specifically, I think it has a brand that's equivalent to Apple. I think it has a data moat that's probably equivalent to Alphabet or Google. It has a network moat that probably is akin to Facebook. And going back to the Amazon analogy, it's effectively a one-stop shop now for a lot of LPs, which is obviously kind of the business model that Amazon has. And then just to take it a little bit further, and I'll talk about this in a second, Blackstone is, the next leg of growth here is really going to be two very massive markets. One is retail and the other is insurance. And that compares a little bit to Microsoft, where people saw it as a B2C company, but the hidden asset there was really Azure, and that's where a lot of the growth was. So going to kind of the 5 points I had written about, I'll take each one of them really quickly. The 5 points are also I think kind of misperceptions that a lot of people have. Number one, per the last earnings call, AUM, assets under management, are now approaching $900 billion based on what they have in line of sight. Blackstone will be $1 trillion asset manager, which in itself is sounds mind-blowing for especially a lot of us who scratch and claw for the incremental $10 million or $20 million of capital. But the market size of each of these is individually is massive. So institutional, call it $50 trillion of assets out there. Private wealth, $70 trillion of assets. Insurance, $30 to $40 trillion of assets. So if you take any one of these, Blackstone's AUM in totality, which is, like I said, 900 trillion right now, is less than 1% of the total $150 trillion market. I framed that initially just to kind of highlight the fact that despite the fact that we're at $1 trillion, Blackstone's TAM is massive, and they have a lot of legroom to grow. One point from the last quarter, they raised $150 billion in just one quarter throughout those different asset classes. So it just gives you kind of the scale and their ability to raise money even in a 3-month period. So I'll go on to kind of the second point here, which is effectively twofold. One is, just one second, I'm just pulling up some notes. Okay, sorry. So the second point and it's somewhat of a a misperception is, what creates kind of the sustainable moat here. And look, I think when you look at the performance numbers since inception, whether it be private equity or real estate, on average, they return 2.2 times gross MOIC, multiple on invested capital. So, why is that working? I think the moat here is being created by really three factors. One is, given their scale, they just have much better information than most other parties out there. Number two, they and all of this is kind of a flywheel. Number two, because they have the returns, they have more customers or more LPs coming to them. And to be, those LPs are effectively buying more products from them. They now have 60 different products that are available on their platform. So it really becomes a one-stop shop. If an LP, let's say Texas Teachers, not only wants private equity, but they see that Blackstone now has infrastructure, they have real estate, they have they're relatively nascent growth products. That creates another moat, because it effectively makes it easy to buy other products off of Blackstone's platform. And then the third is the performance, the scale drives effectively an environment where it's easy to recruit the best talent, right? So it's the employee count at Blackstone, and I'll get to an interesting stat later, is around 1,000 people. 1,000 people managing $1 trillion. They probably and they do get to pick the best of the best out there. So effectively, those are the three things that really drive the returns, the moat, and I think that flywheel is kind of impenetrable when you think about the stickiness of those three. I think the third point, and perhaps a misconception, especially as we go into the environment that we're in with geopolitical concerns and credit spreads widening earlier this week, is the alts are high beta cyclical companies. I would say that, look, one has to distill that business model into two components. One component is the fee related earnings, which is effectively just the management fee that the firm gets paid on an annual basis. That is actually a counter-cyclical element to their business, which makes up about 60% of their earnings. And it's counter-cyclical simply because when we have markets dislocated like we have over the last month or so, it allows Blackstone to deploy their dry powder. A lot of that dry powder is sitting there not earning fees. So you have a pretty stable fee basis. When markets become dislocated and there's opportunities to buy, that money goes into fee earning revenue effectively, which actually increases the FRE. So that's one part of the business. The other part of the business, granted, is a little bit more cyclical. That is the part of the business where what they call the incentive fee. Obviously, when markets dislocate, it's harder to take companies public. It's sometimes harder to sell companies. So there is some quarter-to-quarter volatility on the performance fee part of the business or performance fee part of the earnings. However, it's over time that has become less percentage component of our overall earnings, and they've moved that entire FRE stream over to a greater percentage of overall earnings. So you'll see more stability in their earnings stream as we go through cycles. The stability is obviously geared towards more of their earnings coming from the fees, but it's also because they're now in 6 different asset classes, and some of those asset classes are not as volatile as their traditional private equity business, such as their asset management, their real estate business, and their infrastructure business. I think the fourth point, which not really a misconception, but something to note here, is that when you look at the average S&P 500 company, insiders, management, they own 10 to 13% of stock. If you look at Blackstone and any of the other alts, extremely strong alignment. Around 40% of total shares outstanding are owned by Steve Schwarzman, senior management, and the employees. They have a very, very strong incentive, especially for employee retention, to make sure that they're doing what's best interest in the stock and for shareholders. And that's evident in their business model, where they distribute about 85% of total earnings to shareholders in the form of a dividend and also stock buybacks. If you look currently, just on a run rate basis, the stock is yielding close to 5%. There seems to be a disconnect when you have well over 60% of your earnings that are effectively, longer term tied up capital that continues to grow and that's being distributed out. Look, it's not a long-term bond, but 45% of their capital is perpetual that continues to grow. And I think that dividend is good. So the cyclicality of the dividend, there will be some quarter to quarter based on some of the earnings that come out of the performance side of the business, but there is a baseline earnings there, which is well over 2% at current prices that investors can bank on. I would say the last part of this is valuation, and I've been involved with the stock since 2010. I'd say for the better part of that last decade or so, I've always thought of Blackstone as one of the best value growth opportunities in the market. As I sit here today, kind of re-underwriting it after the stock doubled over the past year, I look at it, and I wouldn't consider this certainly a deep value or even a value play. What it is a business that is going to be a compounder. It has a fairly full valuation now. However, there's a really strong pathway when you think about the TAM, when you think about their positioning, and when you think about the leverage in the model, where the incremental capital doesn't necessitate hiring hundreds of new people. When you put all that together, you have a business that can continue to compound earnings at a fairly steady rate of mid-20s to maybe even high 20s over the next several years as they surpass well over $1 trillion. That's effectively the thesis on Blackstone. Is pretty straightforward. I think those investors who are focused on dividend, it offers them a phenomenal opportunity here, yielding close to 5%. I think for guys who are looking for secular compounders, it fits that category. The one strong catalyst here that I think is imminent, which is not priced into the stock currently, is I do believe Blackstone is positioning for addition to the S&P 500, which I think will not only bring a lot of passive investors in, but it'll certainly bring a lot of mutual funds in that track those indices as well. So there's a couple catalysts here, but the real catalyst is really, look, this has now become a compounder. They're a juggernaut, and I think you can hold this for many years to come with a market cap of around 100 billion, participating in an industry that's now $150 trillion and growing. I think there's a lot of leg room for them to continue growing. So that in summation is the pitch.
Yeah, Samir, that was excellent. Thank you so much. I think when you look at it, it's just incredible kind of see that those figures that they posted last quarter, and sort of just their overall sort of scale and growth as a business overall. So appreciate the commentary here. I see we do have a question in from Divya in chat right now. Can Blackstone 10x their AUM while maintaining the current fee structure? So maybe a little bit of commentary on that, and whether you think sort of with scale comes a kind of compressed kind of fee schedule.
Yeah, look, it's a topic I've revisited time and time again. The world is bifurcated today. It is bifurcating. On one hand, you have the BlackRocks of the world, where the fees are compressing, by the year, and on the other hand, you have the alternatives of the world, and there's been no indication, at least on the institutional side, of fee compression, and partially that's been driven by the fact that they have been able over many cycles to produce really attractive returns for their LPs. On the certainly in the other growth areas of retail and insurance, the fees are not as attractive as they are in the institutional business. So there will be some fee pressures on those. But look, the scale of what they can do there is still significant, and they're solving a real problem that both the retail channel is suffering from, and certainly the insurance industries are suffering from, with the liabilities that are in front of them. So I think they'll be in a position of power for a long time.
Great. Saw another comment here, Samir. Can you comment a little bit on how Blackstone is kind of positioning itself from a competitive standpoint in comparison to some of its peer firms? Like the KKRs, Carlyle's, the world. Of course, you've read not all of them, so it'd be great to get your sort of thoughts on this.
Yeah, I mean, Blackstone is a clear leader in the space from a scale perspective. I don't know the current numbers, but I think if you add up the AUM of all the other guys, I think maybe now it exceeds Blackstone's with Apollo's recent purchase of Athene. But at one point, Blackstone had, more recently had more AUM than all of them combined. So from a scale perspective, they're different. The models are where they were, back 15, 20 years ago, effectively all private equity firms, and you saw them doing similar deals. They've all gone in different directions. So it kind of depends on what kind of ice cream you'd like. I'd say Blackstone, the business model is differentiated in two ways. One is they probably are the most diversified across asset classes. So they are in real estate, they are in private equity, they are in infrastructure, they are in a bunch of new growth businesses. They're investing in their BAM business, life sciences. So in terms of diversification, I don't think anyone compares. The other aspect to realize about Blackstone is they are capital light. They don't need a lot of capital to run their business, and they distribute out most of their capital. Whereas if you look at some of the other players, which look, there's nothing wrong with it. It's just strategic, different strategies. KKR has a large balance sheet, which has been extremely successful for them. They compounded their balance sheet, 15 to 20% for many years, and but it's worked for them, right? Apollo went from asset light to buying in their insurance entity, which is Athene. So that changes the dynamics a little bit there. And then Carlyle, their mix has been different, and their strategy in private equity is very different in the sense that they run a lot of smaller funds that are localized. So you'll see that Blackstone has a 56% margin on their FRE. Carlyle is much lower than that, and that's because of the difference in the business models. So it's a very capital light model with a nice dividend yield, which is one of the reasons I like it a lot.
Awesome. And another question coming in here. Can you comment a little bit about the effect of sort of the Fed tightening on Blackstone's business, and what how sensitive these are to any movements in sort of rates or whatnot.
Yeah, look, on the margin, there are going to be parts of their business that will be affected, right? However, like bigger picture, when I look at some of their larger businesses, whether it be real estate. Now, real estate, for example, they're just not, buying real estate blindly. They're very thoughtful. And John Gray's been very thoughtful, having built the real estate business for over 30 years of where he wants to be. So, on the real estate side, they're very focused, and the majority of their portfolio is in logistics. They are in assets where they can raise rates, right? So logistics, apartment rentals, those are areas which have secular tailwinds to them, and will be less impacted by rates, because they'll be able to push those through and pass those on, right?
Right.
BCred, I believe, is if I remember correctly, I'll have to go back and check, is 100% floating. So they've positioned their businesses to really be, I don't want to say a beneficiary, but resilient, or more resilient to the what's going on with the Fed and rates. And that holds true for their private equity business as well. Whether it be refinancing their rates and stretching out those it's basically fixing rates on their investments, and being in sectors that are less resistant, where they do have pricing power within those companies.
Excellent. Any other questions for Samir? I'll say one right now. Go on, Divya.
I was going to say, it looks like we've got one from Vijay. Could you comment on how you would size this relative to other compounders in the current environment?
Other compounders in the sense of other great companies?
Unclear. Maybe Vijay can clarify that, if he means other alts or just other compounders, broadly speaking. And then his second question was, what's a good hedge to alts in other sectors?
Got it. So in terms of the relative attractiveness of this one, look, at the end of the day, this is the most liquid. It's the largest one. It's probably the highest quality. I think in an environment where you have these type of dislocations, this is probably the safer haven relative to the other ones. Although, I think the other ones are great long-term investments, as this one is. Relative to the broader universe, I think the great thing about this one is, it will have these quarters or these times, as we've seen over the last couple of weeks, where it's treated as the higher beta name, so they sell off a little bit more than maybe the average great compounder stock, right? Like, this is going to sell off more than Berkshire Hathaway. However, those are the opportunities to get involved, because you'll see as they go through quarter to quarter, the resilience of their earnings power, and the resilience of their dividend. So it gives you the markets as they are today. It gives you great opportunities to buy a stock like this. In terms of hedging, I don't have a great answer for that. These are very challenging to hedge, only because they're a niche kind of sector of their own. You could play some relative value hedging, but I typically in the past have either hedged with indices, XLF, high yield indices, but there's no great way to hedge these, quite honestly. And I've hedged them before, but there's no great correlated hedge to them.
Samir, can you comment on AUM growth in terms of where it's coming from, retail versus traditional institutional institutions that would maybe have increased their allocation to private equity? Like how much of the contribution to AUM growth is coming from retail?
So, I think they talked about it in the last quarter. Retail is obviously it's probably their greatest growth driver, but it's also a smaller base. So I think they raised about $13 billion of capital in the fourth quarter across B-REIT, B-Cred, and B-PIF. So B-REIT more than doubled to, I think, about $60 billion of NAV, if I remember correctly, but that was kind of based on performance. The institutional channel is interesting. They basically guided to $150 billion of new capital over the next 18 months. And that's coming from a range of different funds. I think if I remember correctly, it's coming from 17 different funds. And that includes things like Asia, Europe, credit, growth, tech ops, real estate, infrastructure, European credit. So it's a pretty diversified fundraising cycle that should amount to, based on what they said, and they have pretty good line of sight, to $150 billion. That in itself gets them over $1 trillion. So that's a big chunk over the next 18 months. And then, they also have insurance, right? Insurance doubled, I think, last year to about $160 billion. AIG, which is their partner here, I think has committed to another 40 to 50 billion over the next, couple of years, I think. So it's really coming from, retail, obviously. I think there was 50 billion in retail last year, and that continues to grow. It's going to come from institutional. Obviously, those tend to be a little bit more, I don't say cyclical because they now have so many different funds, but those are drawdown vehicles. And then they have, the insurance side as well. So all three parts of their business and that's one of the look, I pitched this as a buy and hold forever stock. But as I look out, despite the tumult that we're in right now, if I look out over the next 18 months, they have a very strong line of sight into all three of those channels, retail, insurance, and institutional. So you can bank on that over the next, call it 2 years or so, to drive FRE.
Samir, I see another one popping in right now. At what price, would you be comfortable, sort of allocating a significant amount again? Yeah, it's a very good question. One I think about every day as I see the volatility. I didn't really talk about valuation here because I'm pitching this as a compounder. But look, a high level, I triangulate on a number of different metrics. The one I've always kind of went back to is how do I look at this as a sum of the parts? I think they put some preliminary numbers. Michael Che who's a phenomenal manager, and I respect him a lot. I think that him and the team there tend to be very conservative. I think that they'll easily do by 2023 350 of fee-related earnings. I think you can put a high 20s, maybe even 30 multiple on that, given the type of that's 50% that's perpetual. It's a very high margin. It's line of visibility. So that gets you to call it $110 of value that you can bank on there. The performance side of the business should do 250, 260 of earnings. That tends to be volatile, so maybe put a mid-teens multiple on it. Although people would, in the past, people have put a much lower multiple. I would argue if you actually look at that performance fee over the cycle, it's actually been pretty consistent. So maybe less than a market multiple there. That gets you another kind of $40 of value. So you can easily get to $150, $160 stock. And today, I try not to look at my screen these days, but I think it's trading at 110 or so. 116.
116. So you know, there's a 30% upside, and I think that's at those multiples. But you see a scenario where they continue growing 25% and compounding over the next handful of years. And like I said earlier, there's a lot of support here with the dividend as well, which should support the stock. So, you know, I think anywhere below 110 seems to be a very interesting risk reward right now. And I say 110, and my basis on that is you can bank on the FRE number, and then you can put a multiple on that, and that should, in my opinion, be your downside, because that money's not going anywhere. That comes in every day, effectively, the fees that they charge. So that 110 to me is my at least from a fundamental standpoint, where one can get constructive. It looks like just on Bloomberg, it looks like it bounced off that level the other day.
Yeah.
So.
Yeah. Well, Samir, no further questions, I think, on our end. So appreciate your time, and looking forward to talking with you again. I do think my colleague Braden here does have some kind of final thoughts for us all, but thank you all for participating. I know you're probably sick of all seeing my face, so I'm going to turn things over to Braden.
I just say thank you to everybody for joining this. I think we're going to look to bring a lot more of this to you guys in the coming weeks and months and over the course of the year. Obviously, the full pitch from Will, Adam, Sia, Eric, and Samir, it's all on SumZero, but I think it helps us sort of bring this stuff to life in a full-on conversation. It allows you guys to sort of dig in and ask questions and help bring the community together. So, look, we found 5 opportunities presented across multiple regions, sectors, market cap. Many of these names are not well covered or in some instances at all. And that's something SumZero has looked to do for years, and we'll keep trying to do that. So appreciate it. You know, look out for the next call. We're going to be doing one on C Limited this coming Thursday, so the invite should be out shortly. But again, especially to the folks that brought us through their work today, a big thank you. I hope you guys enjoyed it. And if you guys have any questions, if you want to chat with any of these managers individually, by all means, reach out to us. We're happy to facilitate any introduction. Easily done at access@sumzero.com, and we'll put you guys in touch. But good luck out there. Enjoy the rest of the week, and hopefully we'll see you this coming Thursday. Thanks, guys.